We hear a lot about getting humanity back to the moon and eventually to Mars. But before any of that sci-fi stuff actually happens, Elon Musk's rocket company is gearing up to take us straight to the cold, hard reality of the Nasdaq. Welcome to this explainer. Today, we're unpacking the monumental S-1 filing behind SpaceX's upcoming IPO. And let me tell you, the numbers attached to this potential public offering are literally staggering. We are looking at a financial event that could completely rewire how the markets value aerospace, technology, and telecom companies, all at the exact same time.
So here's our game plan. 1. The $1.75 trillion question. 2. The 3 pillars of SpaceX. 3. The valuation reality check. 4. Why it might actually work. And 5. The ultimate control.
All right, part 1, the $1.75 trillion question.
It's been widely reported that SpaceX is targeting a $1.75 trillion valuation. I just want you to take a second and let that number sink in. $1.75 trillion. If they pull this off, that target valuation immediately makes SpaceX the 9th largest company in the S&P 500, right out of the gate. We're talking about the world's biggest IPO to date, effortlessly eclipsing legacy giants that have been building wealth for literally over a century. Companies like Warren Buffett's Berkshire Hathaway. But a number this incomprehensibly large, it really needs some context before we can even wrap our heads around it. To really illustrate the sheer magnitude of that number, let's look at this lineup. SpaceX is claiming to be worth more than Boeing, Disney, McDonald's, AT&T, American Express, and Home Depot combined. Seriously, let that marinate. It is an absolute massive financial flex, suggesting a single commercial space enterprise is more valuable than global leaders in aviation, entertainment, fast food, telecom credit, and retail hardware put together. But because they're filing an S-1, which is that comprehensive legal document showing off their financials before going public, we actually get to peek behind the curtain and see if this valuation holds any water at all.
Moving right along to part 2, the 3 pillars of SpaceX. So for 2025, SpaceX posted a total revenue of $18.67 billion. Let's break that pie down, shall we? The original rocket business, the exact same one responsible for a whopping 80% of the total mass launched into orbit last year, that only brought in $4 billion. The brand new AI segment formed after the XAI merger generated $3.2 billion. But the absolute lion's share, well, that belongs to Starlink, their satellite internet service that's currently beaming high-speed connections down from 9,600 satellites to over 10 million customers worldwide. At $11.4 billion, Starlink is the undisputed revenue engine here. In financial reality, SpaceX isn't just a rocket company. It's a massive global telecommunications business wearing rocket company branding. But revenue is only half the story, right? We have to look at the stark contrast in profitability to truly understand the survival mechanics of this business. Like, what do they actually keep at the end of the day? Well, the rocket division, heavily burdened by some serious R&D for the massive Starship program, lost $657 million. The AI segment? Absolutely guzzling cash, losing a massive $6.4 billion as they race to acquire compute power. But Starlink, with its nearly 39% operating margin, is generating $4.4 billion in pure operating income. So essentially, Starlink is carrying those incredibly heavy cash-incinerating losses from rockets and AI squarely on its back. We can't romanticize this setup too much, though. Despite Starlink's phenomenal, market-leading success, the consolidated numbers for the first 3 months of 2026 are a harsh reminder. The overall company is still incredibly capital-intensive. They posted $4.7 billion in revenue, but a $1.9 billion loss from operations. They are burning through vast amounts of cash to fund all this enormous terrestrial and orbital infrastructure. It begs a really serious rhetorical question. Just how long can one single, highly profitable internet service fund humanity's outrageously expensive push to the stars? Which brings us to part 3, the valuation reality check. Based on their current, tangible earnings today, the short answer is simply no. When you see a valuation this spectacularly high for a company that is actively burning billions in cash, it means investors are pricing in massive, explosive, and frankly, flawless future growth. So let's play along for a second. Let's run a highly generous thought experiment based on their 2025 operating cash flow of $6.8 billion, just to try and find their mathematical intrinsic value. Okay. We're going to do something you should literally never, ever do in actual finance. We're going to completely ignore capital expenditures. Yep. For a company whose entire business model relies on building massive, multi-million-dollar metal rockets that explode, we'll just pretend they get to keep all $6.8 billion as pure free cash flow. Step 2, we'll assume they can sustain a massive 20% growth rate every single year for a decade without a single hitch. Step 3, we demand a remarkably modest 10% annual return, which is roughly what you'd expect from a boring, safe index fund. And step 4, we assume we can somehow sell the whole business in 10 years for a hefty 20 times multiple. Even if we do something this mathematically silly and assume these perfectly generous, virtually impossible conditions, we get a very revealing result. The discounted cash flow intrinsic value comes out to $438 billion. The math tells us that the true intrinsic value falls over $1 trillion short of their $1.75 trillion target. We were exceptionally generous. We completely broke the fundamental rules of corporate finance, and we still aren't even close.
Moving to part 4, why it might work. So SpaceX isn't just throwing random, unjustifiable numbers at a wall here. They're actually executing a highly calculated strategy to raise $75 billion in new capital. First off, they're launching into the second most euphoric market in history, trailing only the absolute frenzy of the 1999 dot-com bubble. And we all know that was a time when foundational business logic didn't matter anywhere near as much as a good narrative. Right now, investors are paying premium prices for tech narratives, meaning SpaceX can raise significantly more money while giving up far fewer shares. Second, they're actively weaponizing retail loyalty. And third, they're hacking passive ETF inflows. Let's break those down. It is absolutely no secret that Elon Musk's companies command a cult-like following. Fans are deeply emotionally invested in this whole mission to make humanity multiplanetary. They love watching those Starship chopsticks catch 20-story rocket boosters right out of midair, and a lot of them are going to buy this stock and simply never sell it. Now, unlike most typical IPOs that throw a measly 5 to 10% of shares to retail investors, SpaceX is intentionally reserving 30%. They are banking heavily on the fact that this loyal, fanatical fan base won't immediately engage in that typical post-IPO pop-and-dump trading. Essentially, they're building a massive concrete floor under the stock price using pure fandom. Furthermore, there is a fascinating structural advantage at play here. Historically, newly public companies had to wait 3 whole months to be included in the prestigious NASDAQ 100 index. This was a necessary cooling-off period designed to prevent crazy post-IPO volatility from throwing the broader market into chaos. But get this, the NASDAQ is actively bending its own historical rules. They're shortening that critical window to just 15 days. It's entirely a systemic manipulation to entice massive private companies like SpaceX, OpenAI, and Anthropic to list on their exchange rather than taking their business somewhere else. Now, this rule bending matters deeply because of something called the passive investing effect. The NASDAQ 100 supports over $600 billion in tracking assets globally. This means hundreds of ETFs and index funds will be structurally forced to buy SpaceX shares on pure autopilot simply because it got added to the index. The algorithms, they don't read S1 filings, they don't care about cash burn, and they definitely don't calculate intrinsic valuation. They just buy, blindly. Which means whether you actively choose to or not, you might very well soon own a piece of SpaceX in your 401k or retirement account. That provides a massive, unthinking structural support beam for that lofty $175 trillion valuation.
Finally, part 5, the ultimate control. The S1 reveals an absolutely staggering pay package for the man at the center of the whole thing. Elon Musk has been granted 1 billion performance-based restricted shares, cleanly broken down into 15 tranches. Now, to fully vest these shares, he has to hit 2 massive, entirely unprecedented conditions. Condition A requires hitting financial milestones all the way up to an astronomical $7.5 trillion market cap. Condition B? Well, it requires the company to establish a permanent human colony on Mars with at least 1 million living inhabitants, all while Musk is still employed there. Yeah, you heard that right. Corporate compensation is now literally tied to interplanetary colonization. Obviously, putting 1 million people on Mars seems pretty outlandish anytime soon. But here's the catch. The hidden twist buried deep in the fine print of the S1 filing. Those restricted shares, they've actually already been issued to him, and they can be voted right now. So regardless of whether he ever gets a single human being to Mars, or if he completely misses those sky-high financial targets, those uninvested shares grant him immense, immediate voting power today. In fact, with his pre-IPO controls sitting at roughly 85.1% of combined voting power, the legal filing makes it incredibly, unavoidably clear. Whatever Elon Musk says goes. The public markets and passive retirement funds might be fronting the $75 billion in this IPO to fuel the engines, but make no mistake, the public will absolutely not be steering the ship.
So I want to leave you with this final thought to chew on as we wrap up this explainer. You have a company missing its intrinsic valuation by over $1 trillion. It's relying heavily on a profitable global internet service to fund deeply cash-burning rocket and AI operations. Yet it's powerfully propped up by perfect historical market timing, rabid retail loyalty, and autopilot index buying. Given that monumental $1.75 trillion valuation and the absolute centralization of executive power, are you comfortable investing your capital into a company where you have absolutely zero operational control? It's the multi-trillion-dollar question every single investor is going to have to answer when SpaceX finally hits the ticker.